Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, we have stocks that have been kind of mixed following a weak ADP report. We'll have more on the labor market and what it means for the Federal Reserve. Plus, the AI race heats up. We'll hear how Wall Street is viewing AI competition. And we'll talk to the former CEO of Intel, Pat Gelsinger, as his chip startup raises $150 million from the U.S. government. Let's get a check on what's going on in the major averages first of all here. And indeed, we do have this mixed picture. The Dow very slightly higher, not even a fifth of 1%. The S&P down very slightly. The NASDAQ down about a third of 1% here. We continue to watch the action in large cap technology. And there, too, we're seeing a mixed picture today. In particular, we've been watching Microsoft after a report by The Information that the company was cutting down its AI software sales quotas. There's been, as we've been talking about, this sort of what Mike O'Rourke from Jones Trading called an AI civil war, or sort of jockeying for position within some of the big chatbot providers, and kind of repercussions for what that means for the whole ecosystem. That's what investors seem to be trying to figure out at a time when we've also obviously seen a run up in many of these stocks thus far this year. Just looking elsewhere on this, Netflix is standing out. The shares are now down almost 6% on no particular headlines that we could see, but something that's worth pointing out. I'm also seeing Micron in dark red here today. It's off by more than 3%. As for the sectors, the S&P 500 today, we've got energy that is actually up the most here today, and tech is down the most. So kind of a flip-flopping of what we saw yesterday. And the Dow is the outperformer today by a hair. Not up much, but it's up a little in terms of why the Dow is doing better than the other major averages. Nike helping lead the gains today, and we should say Nike is one of the worst performers of the year. So as we get into December, as we get closer to the end of the year, we do tend to see some rotation out of some of the best performers into the worst in some cases. So perhaps that's what's going on here with Nike today. We'll keep an eye on it. Meanwhile, new data from ADP showing a weakening labor market, with private payrolls unexpectedly falling by 32,000 in November. Our Federal Reserve correspondent Jennifer Schomburger here now with more on the numbers and what they could mean for the Fed, because we're still waiting for the government data for November, of course.
Good morning, Julie. Indeed, we are. That ADP report from payroll processor ADP showing a loss of 32,000 jobs for the month of November, though we did see October revised upwards. It was a gain of 47,000 jobs coming off of losses in September and August. So a very volatile pattern here for private sector job creation over the past 4 months or so. ADP saying that it appears that job creation has been essentially flat in the second half of this year. This is probably not going to change the picture much for the Federal Reserve. Those who are worried about fragility in the labor market will point to this report and say, yes, we do need to cut in December. Those who are saying, no, we think that the issues with the labor market have to do with more of the supply of workers, lower immigration. We feel that the labor market is sort of in a stasis, steady position right now. We'll probably hold to that thesis based on this report. So I don't see this changing the calculus for next week. It does look like the Fed will move forward with a rate cut. I think the bigger determining factor when it comes to the job market and how Fed officials are looking at the path forward for rates is going to be on December 16th, when we finally get a report from the Labor Department on the November jobs report. Of course, that's going to be coming after their policy meeting next week on December 10th. So that will have implications for next year.
Indeed it will. And speaking of next year, Jen, President Trump is expected to name a new Federal Reserve chair, of course, to replace Jerome Powell. And we've been doing a deep dive into each of these 5 candidates on the short list: Fed Governors Christopher Waller, Michelle Bowman, former Fed Governor Kevin Warsh, National Economic Council Director Kevin Haas, and BlackRock Head of Fixed Income Rick Rieder. So, Jen, who are you focusing on today? Christopher Waller. Tell us all about him.
Yes, Christopher Waller. And the case for Fed Governor Chris Waller is that he's already a member of the Federal Reserve Board of Governors, and his views are in line with President Trump's. In fact, he was the first central banker to call for cutting rates all the way back in July after the Fed's meeting in June. And he was appointed by President Trump back in 2020. Taking a look at his bio and his path as to how he got to where he is, before the Federal Reserve Board of Governors, he served as the director of research at the St. Louis Fed from 2009 until December 2020. And in addition to his experience at the Fed, Waller served as a professor and chair of economics at the University of Notre Dame. He was also a research fellow with Notre Dame's Kellogg Institute of International Studies, and he served as a professor and chair of macroeconomics for monetary economics at the University of Kentucky. He holds a BS in economics from Bemidji State University and a PhD from Washington State University. Now, when it comes to his views, Waller supports cutting interest rates this month because he says he's more worried about the job market weakening than inflation accelerating. He believes that lower payroll growth is being driven by both weaker demand for workers and weaker supply of workers due to lower immigration, but he thinks that it's weaker demand that is the bigger issue than supply. Now, on inflation, Waller says that the data through September continue to show relatively small effects from tariffs, supporting his hypothesis that tariffs are having a one-off effect of raising prices and are not a persistent source of inflation. Excluding tariffs, Waller says he believes inflation is close to the Fed's 2% inflation goal. Now, after December, come January, while Waller has been calling for consecutive cuts, he believes that the Fed is going to need to take things meeting by meeting, so perhaps taking a more cautious approach there, whereas President Trump still thinks that rates need to be a lot lower than where they are right now. Julie?
Yeah, that definitely seems to be the consensus around his thinking here. So, Jen, the president might already know. He says he already knows who he wants to choose to be the next Fed chair.
Yeah, that's right. We heard from President Trump yesterday when he said during his cabinet meeting that he knows who he wants to pick. So before, we had heard from him a couple weeks ago saying he probably knows. Sounds like he's more certain now. And he said, we're probably going to get an announcement early next year. We'd originally been told by Treasury Secretary Bessent, who's leading this interview process for the next Fed chair, that we were going to get an announcement sometime by Christmas. So that being pushed out into next year. We also heard from the president about Kevin Hassett yesterday, who is his, of course, National Economic Council director, and one who has been said to be the front runner and perhaps the president's pick. And media reports, he is also rated in Polymarket as the first choice. Take a listen to what the president said yesterday about Kevin Hassett.
And I guess a potential Fed chair is here too. I don't know. Are we allowed to say that? Potential. He's a respected person, that I can tell you. Thank you, Kevin. I want to thank you all for being here. It's a great group.
Feeding fuel to the fire and narrative that Kevin Hassett will be the pick. But Treasury Secretary Scott Bessent was just interviewed moments ago by Andrew Ross Sorkin at the New York Times Deal Book Conference. And Bessent was asked about whether Hassett is going to be indeed the president's pick for the next Fed chair. And he sort of demurred, saying that he wanted to explain how much authority the chair has and influence over interest rates by saying it's really the committee that sets interest rates. And he also went on to critique the Fed, Bessent that is, pointing out that some of their regional officers are not from the regions that they serve, and that they should have to have lived in the regions that they are Fed presidents for at least 3 years. So that was a little bit of interesting information there, but still no concrete clues from the administration, as those of us here in the press really try to drag it out of them. Julie?
Yeah, I mean, that seemed to be a coy little clue on the part of the president, or maybe not so coy. Maybe it was a very obvious clue. I don't know. We'll see.
We'll see. I just find that we always think we know who it is, and then all of a sudden we get surprised. So it's very hard to handicap this.
Yeah, and like almost anything else with this administration, including the path of tariffs, et cetera, it's a long list. We don't have time to enumerate all of it. Thanks so much, Jen. Appreciate it. We got much more markets action coming up. You're watching Market Catalysts. UBS held its Global Technology and AI conference this week, bringing together industry experts and CEOs to discuss investment opportunities in artificial intelligence. The conference also comes at a time when Wall Street is watching AI competition heat up. Joining us now, one of the participants at that event, Autodesk President and CEO Andrew Anagnost, here with me in studio because you were just here for that event. And you guys made headlines yesterday. A lot of the participants there made headlines yesterday. And I'm curious first to sort of get your impressions as to the AI ecosystem, what you heard yesterday, and kind of where it is, because it feels like there's a lot of jockeying for a position
there's certainly a lot of jockeying, a lot of emphasis on the infrastructure build out. Mm-hmm. We're benefiting from the infrastructure build out. You know, we make software for people that make things, right? And the infrastructure build out in the digital infrastructure space around data centers and things like that was a part of the tailwinds to our business. So a lot of focus on the infrastructure, people trying to figure out what happens to vertical and horizontal SaaS software after the infrastructure build out. And there's bulls and bears on these things. We're one of the stocks that's actually benefiting. People see us as complex vertical SaaS, so they see us not being disrupted by kind of the horizontal big hyperscaler players. But there's a lot of concern out there about where this is all going to end.
Yeah, and you and I have talked about this before, about sort of where you sit in the new AI, and that you don't believe that what your clients do will be disrupted and replaced by pure sort of AI functionality.
You know, Julie, one of the things we've talked about before is, our industry has a massive capacity problem. So let's just look about the data centers right now. Wall Street Journal just ran an article the other day about the gold rush for data centers. But hidden in that article was that 52% of these data center projects are delayed because they can't get enough people to build them out. So there's almost an 11-month backlog on data centers, and it's on average 8 months for the rest of construction. So they need digital technology, and these data center builders are consuming digital technologies because they need AI and they need capacity to execute. The same's true in infrastructure, and the same's true in industrial buildings.
And so they're using your software to design the buildings, and also in a bit of a change to operate the buildings more so
We're
as
moving
well.
much more into the operation.
Yeah, talk to me about how that works.
So look, especially in this industrial build out. So there's industrial build out, factories, read factories. In the US, there is still a factory boom going on. And the real news is not big factories, it's the little factories that matter. It's the machine shops, the mid-market factories that do sub-assemblies. All of these need to be automated to the same degree that the big boys are. So our focus in operations is to help them automate to a degree that they can compete globally. So for instance, if you look at the manufacturing sector right now, by 2030, there's going to be a shortage of 2 million skilled laborers in the market. We're never going to fill that gap. So not only do we need to upskill labor, but we need to automate these new factories that are being built to a heavier degree than they ever have been before if we want to be globally competitive.
So when you talk about doing more projects with fewer people, which I know is something that you have talked about, who are we talking about? You're talking about the folks in the factories, but I wonder also, what does that mean for the designers who are using your software?
It's for everyone in the ecosystem. The designing people, the engineers, the construction professionals, they all don't have enough capacity. And we all have a ton of projects that need to be executed. In this last election cycle, about 82%, or almost 280 infrastructure projects were approved by local municipalities over the course of the election. Infrastructure is big, we all need it. Guess what? Some of that infrastructure projects are going to be over budget, and they're going to be delivered late, and the capacity to execute on those on a schedule that they want to right now isn't there. So we want infrastructure. It's too expensive and we can't build it. We need the efficiency. We need fewer people per project, and we need the capacity we have executing on more projects.
Okay, so this is a little bit of a different spin on the concern out there that AI is going to, quote unquote, take people's jobs. What you're saying is there aren't enough people as it is.
There is not enough capacity
So
in
it's
this
not
world.
as though you're taking away from existing jobs that are out there. It's that there aren't enough humans right now to do the jobs that need to be done?
This is the truth. In our industry, in the industry of building things, there are not enough people, there's not enough material, and there's not enough money. So we need to unlock this capacity. We need to drive forward. We need AI to do that. So yeah, it is different in our industry. We're less afraid of eliminating jobs and more afraid with getting people to adopt these technologies so they can unlock the capacity.
That's interesting. And also it's a good question. You know, there's a lot of consternation among young people right now. This is an area where maybe they should be looking if there is need for that.
Absolutely. The built world is a very exciting area.
Yeah, so you guys also just came out with the earnings last week. One of the things that was talked about was some level of macro uncertainty. What does that macro uncertainty look like? I mean, because it sounds like you're saying there's a lot of demand out there. So where does the uncertainty lie?
So when we guided to our Q3, we actually flagged some second half uncertainty that didn't materialize, all right? What we talked about for next year is there's a couple of things that we wanted the street to understand. One, we're still going through the second phase of our go-to-market transformation inside the company. Whenever you change your go-to-market motions, there's usually some risk to the business. But also, you know, as we look out 12 months forward, it's like, it's hard to tell. It's a little cloudy when you go out and you look 12 months out. So we want to make sure that we're prudent in how we set expectations for the next year. It's not that we're seeing anything changing in the consistency of the business. It's just, you know, one, the go-to-market transformation's coming, the second phase, and two, we just don't know what we don't know yet.
Okay, well, what do you want to know that you don't yet know? Not necessarily with the internal transformation, but with the world. What do you want more certainty on?
Look, you know, you want to see continued prudent investment in things, and you want to see stability. You want to see labor markets continuing to maintain their strength. You want to see continued investment in things that are important to the future. You don't want to see increases in speculation, and you don't want to see tightening of economic activity that actually doesn't really deliver the benefits.
Okay, so let me ask you this: the spending plans that we have heard about to build out data centers, does that feel prudent to you? Does it feel like overspending?
You know, look, it's hard to tell. In every one of these booms, infrastructure has always been overbuilt initially, but the capacity ultimately gets consumed over the life cycle of the technology transition. Let's remember, you know, Internet 1.0, right? You know, we all remember that. Infrastructure was hot in the early days of that. It got built out, it got overbuilt a little bit, but eventually all that capacity and then some got consumed. But there was a lag between when the appliers of the infrastructure and the infrastructure builders actually kind of, you know, converged.
Right, and there was also a lag between, you know, those initial builders making money and then everybody, you know, figuring out where that money was going to flow, the profits were going to flow.
That's why when we look at AI, we're just patiently solving real customer problems every day. We're not getting involved in hyping particularly world-changing types of innovation. We're just doing the hard work of automating the processes that get in the way of our customers having capacity. You keep doing that steadily over time, guess what? You're going to consume more of that capacity over time, and you're going to consume it at high value.
Andrew, thanks so much for coming in.
Thank you, Julie.
It's great to see you in person. Thank you.
That's great.
All right, coming up, we'll have some of this morning's top trending tickers, plus the CEO of Citizens will join us on what's next for the banking industry. Welcome back to Yahoo Finance. I'm Allie Canal, live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. We're watching ASML, Oracle, and Roblox. Kicking things off with ASML, Bank of America is doubling down on the company as its top semiconductor pick heading into 2026. The firm says the stock could rally another 20% from here, lifting its price target to $1,331 a share from the prior $1,092. B of A calls 2027 an inflection year for the company as analysts expect chip makers to rely more heavily on ASML's machines, especially in memory chips. That means ASML gets a bigger slice of that spending, and because the company will be selling more of its higher priced premium tools, its profit margins should improve as well. Next up, a big initiation from Wells Fargo on Oracle. The bank initiated coverage at overweight with a $280 price target, saying Oracle is in the early stages of an AI-driven rebound with plenty of upside ahead, even though the stock is still about 40% below its highs. Wells Fargo arguing that Oracle is emerging as a true AI infrastructure leader, citing nearly $500 billion in AI deals already booked and a pole position with major customers like OpenAI, xAI, Meta, and TikTok. And finally, UBS is out with a new note on Roblox.
The bank initiating coverage at neutral with a $103 price target, calling Roblox a unique asset at the intersection of three big gaming trends. One, more social gameplay. Two, hardware agnostic experiences. And three, AI lowering the barrier to content creation. Now, UBS likes the platform's scale, but does expect growth to moderate in 2026 as the company laps several viral hits and steps up infrastructure investments. But analysts still see long-term upside from AI-driven efficiencies, safety tools, and advertising, describing the near-term risk-reward setup as balanced. We'll keep it right here on Yahoo Finance. We'll be tracking all the market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching GitLab, CrowdStrike, and Anthropic. First up, GitLab. Shares falling by the most since 2023 after its earnings. While GitLab's third quarter results topped estimates, its outlook failed to impress investors and Wall Street for that matter. UBS cut its price target on the stock to $51 from $60. The shares are down almost 15%. Next is CrowdStrike. The software company beat earnings and revenue forecasts for the third quarter. It also boosted its fiscal 2026 guidance. The results do signal that resilient demand for its expanding portfolio of cyber security products is intact. CEO George Kurtz said the record quarter was spearheaded by AI within its own product lineup. CrowdStrike has gained about 51% this year, outpacing many of its rivals, so the share's pulling back a little bit today. And finally, Anthropic, the AI startup, is planning to go public in what would be one of the largest IPOs ever. According to the Financial Times, the maker of Claude could launch its offering as early as next year. Anthropic also reportedly pursuing a private funding round that could value it above $300 billion. All of this being said, the FT says it is very early stages here, and the reporting comes as AI competition heats up on Wall Street and more players take on AI giant OpenAI. Coming up, the Trump administration investing $150 million in chip startup xLight. The executive chair and former Intel CEO Pat Gelsinger will be here next on Market Catalysts. Investors broadly in agreement that the Federal Reserve will cut interest rates at its December 10th meeting, but November's far weaker than expected ADP report suggests there could be more uncertainty ahead. For more on what all of this means for the U.S. economy and the banking industry, we're joined by Bruce Van Saun, Citizen CEO, and he's with me in the studio. Bruce, good to see you.
Yeah, great to see you.
So let's talk about the backdrop right now. And we might as well start with rates because that's obviously pretty important to your business. Do you think that the Fed is going to cut next week?
I think the lean is to cut. I think they're still concerned about the economy being a little slow, and inflation, while persistently higher than target, is still under control, it feels like. So more likely than not.
And what are you seeing in your business in terms of the sort of macro backdrop and your feeling about economic growth based on what your customers are doing?
Yeah, so I think there's some momentum here in the second half of the year. There was a lot of uncertainty in the first half of the year, and now some of the benefits of big, beautiful bill, deregulatory push, pro-energy push, starting to pan out and play through the economy. We're seeing still very good deal pipelines. There was a little interruption there when the government closed and getting some things approved, but still pipelines are very strong. And I'd say all segments of the economy that we serve seem to be holding in and doing okay and optimistic about 2026.
I mean, it's interesting that you talk about the all segments thing because we keep having this discussion about the so-called K-shaped economy, right? That the wealthiest Americans are doing very well and sort of subsidizing spend for everyone else. And you have insight line into that in your business. You've got a robust and growing private banking business that caters to wealthy, but you've got a bigger banking business, consumer bank also. So are you seeing that happen in your business?
Well, I'd say the lower end consumer is a bit stretched because, frankly, with inflation high and the labor market is cooled off a bit, it creates a little bit of stress there. So they may be doing less discretionary spend, but they're still in pretty good shape, the ones we serve. We tend to pitch a little higher up the affluent schedule into mass affluent households, but it's clear that disproportionately the wealthy folks are benefiting from high stock market valuations, high home value valuations, and so they're feeling pretty flush and really spending. But it actually all the way through, people are still spending and doing okay.
And what about delinquencies, which we've started to see tick up on the low end? Are you seeing any need to increase reserves at the bank, for example?
Not really, not for us.
It's interesting
Yeah.
that is going that way. And are you pretty confident that going into next year that's going to continue to be on trend?
Yeah, I'd say kind of we're looking at a GDP growth that picks up a little bit next year, 2 to 2.5%, and unemployment doesn't rise very much further, and inflation kind of stays at or below 3 and starts to come back down towards 2.5 by the end of the year.
And as I mentioned, you guys have been growing your private bank, which seems to be a trend really throughout the financial industry. I mean, maybe this is an obvious question, but I'm going to ask it anyway. Why is that business so attractive, not just for you guys, but elsewhere? And is it sort of a market share battle, or because there is a growing number of affluent people, is it a bigger pie also?
Yeah, I think the pie is growing there. So at the upper end, successful people are operating well in this environment, and their wealth is growing through their equity holdings or the businesses that they run, and they're looking for really good advice about either, depending on where they are in life, how do they need diversification, do they need capital to keep investing in their businesses. And so what we try to do is bring together our corporate bank and business solutions for those people, as well as our private bank, which has kind of the personal and family solutions around their banking needs and their investing needs, and estate planning and things like that. And it's hard to do. Like, everybody's after that. I think the secret sauce is to try to figure out how to work across the enterprise to deliver those comprehensive solutions and not get caught up in silos. As banks get bigger, they have more silos, and it's harder for them to do that at the smaller end banks who maybe don't have all the capabilities to actually bring it all together. So I think we're kind of in the sweet spot that we can work across the enterprise, and we can look at a customer as a human being, as a successful person who has business needs and personal needs and family needs, and that's how we approach it. And I think that's a winning formula.
I'm curious, we just learned, I guess it was yesterday or 2 days ago, that Bank of America now has a formal sort of crypto allocation recommendation for its wealth clients of 1 to 4%.
Wow.
Where are you guys at on that?
I think we're more open to facilitating that, the kind of buy, hold crypto, but we don't have that in the allocation at this point. It's gaining more acceptance as a diversifying asset class, but it's still a little early, I would say.
Gotcha. You were just talking about how you think that the size of Citizens right now is sort of well poised to take advantage of some of those benefits you can offer to the wealth clients. That said, do you want to get bigger? You guys have done some M&A,
yeah.
And we've talked about this before, whether there's opportunity for more consolidation in the industry.
Yeah. I think at this point we're very focused on kind of our organic growth agenda. It's like making sure the private bank keeps its growth curve going and really solidify that business and expand it into more markets. So I like to joke that we did our M&A. That was our deal, even though it was a startup. The accretion that's coming from that business, it's going to be 7% of our bottom line this year. It's going to go into double digits next year. And so it's really hard to find a bank that you can buy to get that amount of accretion. So that's very attractive. Having said that, we're still alert to opportunities, and we see some of our peers doing deals. Some of those are attractive deals, and so we'll keep our eye open. But at this point, the principal priority is to make sure we're driving organic growth.
Sounds good. Bruce, thanks so much for being here.
Okay.
Good to
my
see
pleasure.
you. All right, now I want to send it over to our Brian Sozzi. Soz?
All right, good chat there, Julie. Okay, the Trump administration is investing up to $150 million in chip startup xLight as the company looks to develop more advanced semiconductor manufacturing techniques. The government would get an equity stake that would likely make it xLight's largest shareholder. It's always a good day for me when I get to talk to my next guest, Pat Gelsinger, xLight Executive Chair, former Intel CEO and Playground Global General Partner. Pat, good to see you, my man. Before we even get into this deal structure, what is xLight and what is the big breakthrough you're looking for out here?
Yeah, so xLight is a new light source. And when you think about semiconductor manufacturing, build big fabs. In the middle of that are these machines called lithography machines. In the middle of that is light. And light has always been the center. I always joke from my faith perspective, God said, let there be light. And for 50 years, light has been the center of the semiconductor manufacturing process. And what xLight is doing is creating a new light source. And job one for us is plugging into the ASML scanners, as has become the industry standard for advanced lithography, and building this next generation light source. And as the photo is showing here, this is a big facility. It's 100 meters by 50 meters that you build outside of the fab to have essentially photons as a service. This new light coming into the fab and then connecting up to all of the ASML scanners or other tools in the fab. And so the breakthrough is a new light source that would allow it to not only be today's light at 13.5 nanometers, but scale into the future, as I call it, waking up Moore's Law.
Pat, I don't know exactly how to ask this, but you've seen a lot of tech cycles. You've worked on a lot of cutting edge key technology. Is this the craziest technology you've ever been involved with? Because I've never seen anything like this before.
Well, when I was looking for what I was going to do next, Sozzi, after Intel, part of what attracted me to Playground was this company, right? And the fact that I took on the executive chairman role for them, have leaned into them very aggressively. And obviously with today's announcement, the Department of Commerce agrees and the new CHIPS program office that this is breakthrough technology that truly can make today's manufacturing more productive. But even more powerful than that, it's also then enabling the future of Moore's Law and allowing us to go well beyond today's leading edge capabilities into the future. So yeah, this is pretty leading edge, and it leverages decades of research work that have been going on in our national labs and things like free electron lasers and particle accelerators. So it's leveraging that technology to build this next generation light source. So really building on something that the U.S. has been engineering in this area for many, many years, and now taking advantage of it to truly bring manufacturing to America and leading edge semiconductors for the American market. This is exciting.
Pat, you know me, I'm a positive guy. I'm going to assume that xLight is a successful venture. You're making all these cool things by 2028. If we're having this conversation in 2030, what does this technology mean to this country in the future of tech?
Yeah, well, we would want to, I'll say, lower the cost of manufacturing in the U.S. Be able to say, hey, we're able to compete with other sources in the world because we have this technology enabling our manufacturing capabilities in the U.S. And we've also set a course for the most advanced nodes in the U.S. Research is flourishing, new companies are emerging, and we're bringing life back to the semiconductor industry.
Pat, it's not often I get to talk to someone at the top of a company that has just got a big investment from the U.S. government. I mean, this is some serious coin here, Pat. How did this all come together, and what is it like having the government as an investor?
Yeah, and we're excited. Clearly this administration was motivated to move quickly. And with that, I'm thrilled with their sense of urgency in this area. The discussions with the CHIPS office have been going on for a couple of years. Obviously, as I stepped into this role, getting very active with the new leadership that came into place. And, there's been intense discussions over the last several months on the topic. And obviously, this week's announcement was quite the thrill to have this be the first announcement coming out of the new CHIPS office. So, for that, we see them as acting with urgency, picking technologies like xLight that matter in a very significant way and leaning in the big way. They'll become a minority shareholder. Playground, our venture capital firm is the largest, but partnering with them to really, I'll say, rejuvenate on American soil for advanced semiconductor manufacturing. This is a great day.
Pat, you were the CHIPS guy. I think I talked to you pretty much every time you came back from a trip championing that bill or that act. What is the difference you see between this administration in terms of chip manufacturing in this country compared to the prior administration?
I see two things. One is the sense of urgency. I've been critical that the last administration took much too long, to get funds dispensed. We're competing with the world, and that sense of urgency. And second is they're using the full range of tools available to the government, to make this occur. And that's trade policy, that's tariffs, as well as incentives, research. We need to have an all play to fully realize our objectives with reshoring and rebuilding the U.S. semiconductor manufacturing industry. This is a great step.
In terms of the broader tech landscape now, Pat, you've been at the highest rung of corporate America, Intel. I think back to where you were also leading VMware. Our week started here at Yahoo Finance seeing a code red alert from Sam Altman and OpenAI. From your CEO, vantage point, would you ever issue something like that? And what does something like that signal to you about the period we are in AI?
Well, I think I think of AI. Hey, we may have finished the national anthem, but we're still best case in the first inning. We just have lots of innovation in front of us yet. Our chips are too power hungry. The models are, finding limitations of large language models. We need new knowledge representations, for them. Every application needs to become AI infused. We're just at the beginning, and that's before we even get to some of the really exciting stuff like quantum computing. So this is going to be the greatest couple of decades for technologists. And obviously for OpenAI, they've been in an unquestioned leadership position in models. All of a sudden, what Google and Gemini and now, with their, TPUs coming to market, hey, Google is roaring back. Competition is a great thing. And we need more cost-effective AI. So some of these chip alternatives, we're working on new chip companies at Playground, that will be not a little bit better, but 10 or 100x better than today's chips. And of course, that's before we get to new models of computation like quantum. This is a great time to be a technologist.
Pat, you make a heck of a point there that Google is renewed. I mean, the reviews in that new model, mind-blowing. If they're renewed, if 2026 is going to be the year of Google, what does that mean to an OpenAI's future? And do you share the concerns about circular financing? I mean, OpenAI is at the center of so many deals.
So, hey, competition is good. And, I think, quote, Sam's comments were waking up his organization. We cannot presume leadership is given to us. We have to earn it every day. So I think that's good for OpenAI, good for Sam. But there's also other players, obviously Anthropic, Amazon, Microsoft, et cetera. They all need that same sense of urgency. And we have several great startups that we're working on in this area. Circular financing to me, hey, big balance sheets, using those balance sheets in a creative way, no problem with it. But the quality of that revenue that they're committing in the future simply isn't as good, right? Because essentially I'm buying my own future revenue. That's like saying, I have higher credit risk, because rather than you putting your capital at risk, I'm putting my capital at risk. So I think in that regard, you just say it's just not as good as if somebody else were committing that revenue. But I don't think it's a fundamental issue in any way. These are healthy companies with healthy balance sheets. Ultimately, we're not going to get too far ahead of ourselves because we're fundamentally limited by power availability. As I've said, we're not capital limited in AI. We're energy committed in AI. We must build our energy grid more rapidly.
Pat, before I let you go, you of course led the charge to at Intel for making its own chips. Now, some people gave you a lot of guff for that, but now it looks like Apple may be using Intel to make chips. What say you?
Oh, I'm thrilled. If that's the case, I'm thrilled because, this agenda that, we need to have Intel as a foundry, for the industry, super important, priority for me. And I'm happy to see the current team continuing that. And whether that's Apple, NVIDIA, Qualcomm, AMD, all of them need to be building in Intel factories for the future. They need to be building more in the U.S. And if this comes to pass, that's just the beginning. Many more need to do likewise, and happy to see this progress.
It's still wild for me, Pat, to see NVIDIA invested in Intel. I can't wrap my head around it. Can you wrap your head around it?
Absolutely. We were well underway in those discussions when I was there, and happy to see that come across the line. And obviously, I wish nothing but the best for Intel, for Lip-Bu, grateful for the time I had there. But hey, I'm in a good place now, IPOing new companies, launching what we think are game-changing new industry capabilities, and having a little bit more time to spend with my grandkids. So at this time of the year, that's all that matters, Sozzi.
All right, well, enjoy, Pat. Happy holidays to you and yours. Keep fighting that good fight, and we'll talk to you soon.
Thank you so much.
I appreciate it. All right, do stick around. Much more ahead on Yahoo Finance.
Morgan Stanley predicts there could be more than 1 billion humanoid robots in service globally by 2050, and the humanoid robot market worldwide could top $5 trillion in annual revenue. Here with us to discuss the investment playbook for the humanoid robot market is Derek Yan, CraneShares Senior Investment Strategist for this week's ETF report brought to you by Invesco QQQ. And he's here because you guys have a humanoid robot ETF.
Yep.
And basically you're trying to figure out how do you invest in public companies to sort of get to this theme. So how do you think about that? Sort of what's your framework?
Yeah, so we think about like the AI is really disrupting the digital world, but now we're going to see the AI is going to impact our physical world. So we have two technology breakthroughs. One in hardwares, right? Like you have actuators, sensors, batteries now being like so advanced and cheaper, thanks to the advancement in the EVs and drones. Second, you have like AI foundational models, can reason, can like understand our complex real world. Mm-hmm. So those two technology curves now finally converged. So that's make like humanoid and also embodied AI, not just like science fiction, but it's like actually it's going to come to our world like tomorrow.
Right, and you guys, I guess, commissioned a robot as part of the launch of your ETF?
Yeah, actually we have partnered with RoboStore. They're the official distributor of Unitree humanoid robotic in the United States. So we have worked with them a lot on the humanoid side. Actually, we have a humanoid today join our show that we actually can demonstrate to our investors.
And so for right now, most of these things are sort of remote controlled, right? Like they're not yet AI enabled, most of the humanoid robots on the market, right? So when do we get to that point?
So we actually have a great advancement in hardwares. So hardware is so advanced, but the software is lagging. But just like as I said, all the AI scientists and researchers are working on the models. So we're going to see the models progress. Actually, we have seen models be getting better and better. Mm-hmm. NVIDIA and many other model providers is now really putting a lot of resources to build our physical AI models. So I think that's coming. Just like Google's like advancement in Gemini, they have the world model. You have many like VLA models providers. So I think models ChatGPT moment gonna come soon.
And when you think about where you're investing in this, so you've got hardware, you've got software, are you also looking at the chip providers? Is it sort of a full stack approach?
We look at this space as like an ecosystem because this is early times, right? It's already hard to bet on single companies or like just few companies. We have to take a basket approach to invest into the whole ecosystem, mm-hmm. which includes the integrators, right? The companies manufacturing and commercializing the humanoid, and also the brain, right? Providing intelligence, chips, technologies. But most importantly, we think the bottleneck is the body, is the components, the actuators, those sensors, critical materials. Those stuff are not ready yet for mass production, as you said, a billion unit or like 5 trillion market. So we have to deploy a lot of capital to really make that supply chain happen.
And it's interesting when I look at the portfolio within the ETF because you have, sort of established companies, chip makers, but there's a lot of stuff that is more on the experimental track right now. So how do you know which ones are going to be most successful and also are going to make money, importantly, if you're investing in them to go forward?
Yeah, I think like that's why a basket and very diversified approach is the key, right? At early stage, I think a lot of companies, some are already established, but some may not have be profitable yet. But you have this similar growth, like S curve, right? As the humanoid become like consumer electronic, like your next car, your next smartphone, you're gonna see this adoptions gonna accelerate. So that's why you want to bet many key players in this ecosystem.
Derek, thanks so much for coming in. We appreciate it.
Thank you.
And thanks for bringing the robot. All right, coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. Taking a look at the major averages, we are still seeing a mixed picture with the NASDAQ lagging, but little change right now. The S&P 500 up about 0.1%, the Dow gaining almost 200 points at this point. And joining me now is Dave Mazza, Roundhill Investments Chief Executive Officer, to talk more about what's going on in the market. And to me, Dave, one of the more interesting dynamics in the market as of late has been what's going on in big tech, right? We saw a pullback in big tech. We have seen sort of an uneven recovery, but there's also this rotation within big tech, or at least a perception of changing leadership to some degree. And I'm just curious what your thoughts are on that.
I think there's kind of two catalysts that are occurring at the same time. So to your point, the broader environment saw a big pullback away from tech into defensives in November. In fact, actually, the healthcare sector outperformed the IT sector by the largest spread in 20 years. So I think underscoring just such a huge momentum shift. And a lot of the driver for that kind of macro rotation has been the potential for rate cuts, right? So that was sort of getting baked into the market, came off really hard when some Fed governors came out sort of against it, and then that came back on really hard again, and we saw tech recover. But at the same time, under the hood, there has been a changing of leadership, where NVIDIA, and I'll call it kind of team OpenAI, so Microsoft and others and the suppliers in that space, were just kind of ripping higher consistently. And then the Google news happened, and Google's the triple whammy when it comes to generative AI. They were thought of as a laggard, but they're a hyperscaler themselves. They make chips, and they have a large language model. And so now investors are saying, wait a minute, we've kind of forgotten about all these other players because we've been so focused on OpenAI and all of their sort of circular investments that now we're seeing investors sort of reposition and say, who's going to be the winner on this next leg going forward? Even Amazon's news yesterday with their chips kind of gave them some leadership, which we hadn't seen in a while.
Of course, you guys manage an ETF of the Mag 7. MAGS is what it's called. I mean, and is there an argument to be made that, like, maybe it's too difficult to figure out who's going to be the winner, you know, and are the lead tables going to change sort of with each new product update and introduction? And so you should just still buy the whole thing.
Well, I think that's one of the reasons why the Magnificent Seven, the MAGS ETF itself, has seen kind of consistent flows even through some of the volatility that we saw in the name. Because you're absolutely right. Investors, in some cases, don't really have the ability to sort of forecast, well, whose new LMM is going to score higher on whatever particular index, and they don't necessarily care to actually make those decisions. So with MAGS, you get equal weight exposure to the Magnificent Seven stocks, which in and of itself is actually precision on the big cap tech leaders. So every quarter, the fund's going to rebalance back, sell your winners and buy your losers effectively, but still give you that Magnificent Seven exposure cleanly.
I'm also curious about something else I know you're watching closely. You guys have a lot of ETFs that use options in various ways to sort of do various things, create income, what have you. And if we've been watching the market, just single stocks recently, it seems to me, on an anecdotal basis at least, in the last couple of years, the intraday moves in single stocks have just been sort of supersized, right?
100%.
And does that have to do with options? What's going on with that movement?
I think we're at a place where now sort of the options tail is wagging the equity or stock dog. And we have sort of been building up to this for some time. So historically, how I learned fundamentals matter, look at the price multiples, look at the growth multiples. But now with the introduction of single stock options and the broad-based availability for retail investors, along with hedge funds and institutions to buy options and sell options, we now see actually the options market, particularly in smaller single stocks, some of these being, we saw this with quantum, we saw it with nuclear names, really sort of that options volume be the price setter, and it has the potential for huge intraday swings. So what does that mean, right? There's probably a lot of folks listening that are using options effectively, and they can be a great tool for investors. To your point, we use them in a multitude of funds to meet particular objectives. But I think if we think about sort of market positioning, we now also have to think about that as a risk factor, one that maybe you can take advantage of when the momentum's there. But when that turns, like we saw in the early part of November, that will hit those names the hardest, because just as it's really easy to put on a leveraged options trade, it's just as easy to take it off.
Yeah, I mean, I was looking at something like Supermicro, for example, which has really plunged, and one would have to think that it helped it on the upside because it had a huge, parabolic move upward. But one has to think that that's part of the reason for the downside also. Exacerbates it.
Most definitely. So I think that name in particular has some of its own kind of idiosyncratic issues, of course, and a stock is not necessarily immune to what's actually going on with its fundamentals. But because the positioning can happen so rapidly and in such mass, because an individual retail investor, whether they're buying $100, $100,000, may not seem like a lot for stocks with billions of dollars in market cap, or if not trillions. But when everyone is doing the same trade, and then momentum-based hedge funds are piling on, you're definitely going to see the whipsaws.
Speaking of whipsaws, one of the areas that sees whipsaws is in the meme stock area. You guys recently reintroduced the meme ETF. It's not very big, we should say, but we see sort of little spurts of activity within that world. So, is it worth playing in memes at this point, especially if you don't have high conviction on individual names?
Yeah, so it's interesting. So when we think about sort of just these two funds that are lined up, mags and memes, they're kind of like the opposite flavors of M&Ms, right? So one is your big cap tech with incredibly strong balance sheets, robust cash flow, and then memes is really driven by volatility, driven by retail investors. And we saw a huge run up in many of those names because there was a ton of interest in quantum, AI adjacent, crypto names, getting into AI and things of this nature. That's pulled back pretty sharply. A lot of that is driven by that kind of December rate cut coming off the table, then coming back on. But for an investor who's interested in sort of speculative areas of the market, one of the reasons we brought back meme was for people who wanted to take advantage of that, saying we don't believe meme should be the vast majority of anyone's portfolio, but for someone saying, hey, as opposed to seeing is today the day where Beyond Meat's going to get short squeezed, or is Drake going to finally invest in Open Door, you can get access to that basket as part of your broader portfolio.
Okay, and what's the thinking on like the meme activity as a reflection of the bigger market?
So it's interesting. So if we look at sort of the individual trading volume, and then also if you include the options volume, there is a handful of those names, Open Door in particular, and others sort of in the quantum and nuclear space, which have outsized volume relative to their market cap.
Right.
So that's indicative, of course, of traders who are trading the name, right? I mean, it's simple math, but essentially, it's really driven in that case by what's happening in the macro environment and then the individual risk appetite on each of those names. And when we see, it's kind of to be expected, when that risk appetite collapses, like we saw in the early part of November, those names as a group are not necessarily going to perform well. Really in the last week or so, it's seen outsized performance on the upside because that sort of more speculative behavior has come back pretty strong in what I'm calling kind of a reversal of the reversal. Yeah. And today being kind of another good example, if we look at market action today, of where people are kind of trying to pick their winners and really say, what's going to happen through the tail end of 2025, let alone what's going to occur in 2026.
Yeah, and who knows at this point, but I'm sure we'll talk about it again. Thanks so much for being here, Dave. Appreciate it. Coming up, Macy's is issuing disappointing fourth quarter guidance, what the CEO is saying ahead of the busy holiday shopping season. Stay tuned, you're watching Market Catalyst. Macy's raising its full-year forecast after topping third-quarter expectations and reporting the strongest same-store sales growth in more than 3 years. Our senior reporter Brooke DePalma here now following her conversation with the Macy's CEO, Tony Spring. So what did he have to say?
Well, we got to chatting, and the first thing that I had mentioned was sort of this cautious guidance that really sort of set a sour note on the stock at pre-market trading, now roughly flat as we make our way into today's trading session. But what we heard from the CEO was that ultimately he went with this prudent, this cautious outlook because he didn't want to get ahead of his skis, he told Yahoo Finance. He went on to say that they don't take commitments lightly. He said the last thing I want to do is after 3 straight quarters of beating the street and 2 straight quarters of comp growth, get into a situation where we get ahead of our skis. It really dilutes the credibility that we're building with the investment community. Now, keep in mind, Macy's has seen this this support from the investment community over the past year. Year to date, the stock is up more than 30%. That's surpassing the S&P 500. And it's largely because of this turnaround strategy that Tony Spring introduced back in February of 2024. He calls it the bold new chapter strategy. He did say that despite this cautious outlook for the fourth quarter, that they believe that they are very well positioned for the holiday season, that consumers are expected to splurge if they feel like the price is worth it, and also on these little luxury items while being mindful of how exactly they're budgeting this holiday season. He also said something interesting. He said that the company was more profitable than any other quarter, despite the fact that it saw 170 million less sales from the closed stores. They did close about 64 stores. They are expected to close more no longer productive or profitable stores, he told Yahoo Finance. And also, he said that K-shaped economy that we've been talking so much about definitely does help, especially its luxury business, Bloomingdale's. That luxury business saw a 9% growth.
Right, yes, they definitely have access to
that more affluent customer that's doing really well
exactly.
right now.
That's interesting. All right, Brooke, stay right there because we want to talk about the opposite of that, I guess. Dollar Tree raising its annual profit outlook after a strong third quarter as consumers continue to seek value. Still with me is Brooke DePalma and Scott Mushkin joining us as well, R5 Capital founder and CEO. Thanks for being here, Scott. Yes. Brooke, I want to get you just to give us some of the takeaways from Dollar Tree first of all, and then we'll get Scott's take on what we heard.
So Dollar Tree did beat out across all key metrics, revenue, earnings, same-store sales growth yet again. There was just a slight beat on revenue. It came in about $4.7 billion. Also adjusted earnings, like I said, same-store sales grew by about 4.2%. Now that same-store sales growth was led higher by the average ticket increasing by about 4.5%. That was partially offset by just a slight 0.3% decline in foot traffic. But yet again, the higher income consumer continuing to turn to dollar stores. We saw that majority of new customers, 60%. Those that made over 100,000 made up the majority of their new customer base. And also, lastly, they did raise their full-year profit outlook. And what's really been helping this dollar store in particular is that multi-price strategy that they introduced a few years ago. They said that was a key driver of the third quarter.
Scott, as a wonderful old school analyst, you guys were pounding the pavement, you and your team, looking at these stores, right? Trying to see what it is that is bringing in customers. So what kind of stood out to you that made this quarter work for the company?
Well, I mean, one of the things that they brought up is Halloween. And so we do a lot of research, but also consulting. So we're in the field visiting stores quite a bit. And what we noticed at Dollar Tree about, say, 6 months ago was, better store execution, especially around holiday. We think they executed Halloween well. I think that bodes well for the holiday period coming up for them. So we like what we're seeing at a Dollar Tree. I think it's a self-help situation rather than it's some kind of macro. You're really seeing store standards, execution improve. Very early innings there. You're seeing merchandising, multi-price point improve. Fairly low valuation stock, not really in the way of the Amazon, Walmart buzzsaw, as we call it. That's just getting a lot of market share. So we like Dollar Tree. It's our top pick, one of our top picks. And so, stock's up today, but we continue to buy it.
It's been so interesting to watch this high-income consumer turn to these dollar stores. And it seems like this quarter that continued, but they did see a slight fall-off in foot traffic. Let's say this K-shaped economy doesn't continue as strongly as it is now. What does that mean for the dollar stores?
Well, so I think the first point about the economy, I think is really interesting. So if our outlook for the holidays, we've been a little bit more cautious, kind of along the lines of the Macy's CEO and some of the other people we've heard about, from Home Depot and others. I think the economy is definitely okay, and I expect consumers to spend during the holidays. But I think as you get into 26, but I do think it's going to be modest spending in the holidays. As you get into 26, everyone's really excited about the big, beautiful bill, the tax refunds. I think sometimes on Wall Street, we don't look at the other side of the equation, which is higher healthcare premiums, rising electric bills, consumer services continuing to increase in costs. So we think a lot of the benefits of the BBB are going to be offset. And so the one thing that we have going for us still is, the equity market's been pretty strong. So that K-shaped economy that you talked about is fully in play. As we get into 26, if we continue momentum in the equity markets, we probably stick with the K-shaped economy. But we're cautious, probably more cautious than most. We are very, very much focused on self-help situations where we think they're taking market share, their sales and margins can improve. So again, as a firm, we're just a little bit more cautious than I think, broadly speaking, on Wall Street and what I hear on programs like yours.
Yeah, I mean, that's really interesting, Scott, to hear you say that. So if I look at self-help situations, I mean, there are so many sort of potential retail turnarounds that are in progress or being attempted. I got to think of Target as sort of high up on that list. And I'm just looking through your pictures that you guys took from some of your channel checks that you did at some Florida stores. And there's a little bit of good and a little bit of bad from those.
Yeah, I guess the good news on Target compared to where they were about 9 months ago is that their store execution has improved some, but there are still enormous challenges. On-shelf availability is still dreadful, honestly. We think they have significant distribution logistics issues as we go to certain stores and they're in stock, say home goods, and then we go to another store and they're out of stock home goods. They've really struggled setting for holiday, unlike Dollar Tree, which we talked about more. But the real challenge for Target is slow unit growth because of the macro environment, and the Amazon Walmart, as we called it before, the buzzsaw. They are squarely in the crosshairs of that. Walmart in particular has been doing such a good job on fashion, home goods. We don't see that slowing down. And that's a pretty big headwind for them. So they're going to have to invest in their store base, invest in labor, while probably still dealing with sluggish sales. So our earnings outlook for Target is subdued at best. We think earnings could actually go down again next year.
Wow.
Could be below $6. Could be below $6.
So if you're looking at this challenging backdrop, self-help stories is what you're looking for. So if Dollar Tree is one of them, is there another one within retail that really stands out to you that is really going to be a successful self-help story?
Well, it's interesting because it's a popular stock right now, but the one we would point to, mega cap Walmart, it's kind of hard to say, hey, it's a self-help story. But really it is. When you look at where they are from a business model perspective, they're going down the same path as Amazon. And what that is using unit growth to drive volumes over more and more automated facilities. What that leads to is growing advertising, growing memberships. And so they will use price just like Amazon's using price. We just did a big survey on Amazon versus Lowe's. It didn't look good for Lowe's. Amazon and Walmart will use price, drive efficiencies over automated facilities, leading to what we think is going to be a sharp acceleration in their financial performance next year. And again, hard to believe they put up a pretty good quarter, but our thought process through all our research, store visits, and online research suggests Walmart self-help will drive much higher sales next year, and it will come to the bottom line.
Interesting. Well, they've helped themselves a lot already, and I guess there's still more self-help to be done. Scott, it's always great to see you. Brooke, thanks so much for hanging out with me. All right.
Thanks, guys.
Thanks. Much more market action coming up. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Allie Canal, live at the NASDAQ. Let's get a quick check on the market action about 2 hours into the trading day. We're seeing a bit of a mixed picture on the street. We do have the Dow firmly in the green, up roughly 200 points. The NASDAQ composite is off around 0.1%. The S&P 500 pretty much trading flat to the upside at this point. Now, this comes as we did have private employers unexpectedly drop 32 32,000 jobs in November, along with fresh concerns around the AI trade, and that just continues to weigh on the tech sector overall. Now, the big drag here is Microsoft. Shares are down more than 2% after the information reported that the company is cutting AI sales quotas. That's reignited concerns that AI demand may not be as strong as big tech hoped, and you are seeing that ripple across the space. NVIDIA, Broadcom, TSMC, all trading lower in sympathy. Now, we do have some notable pockets of green. We have Alphabet and Tesla up around 1 and 2%. Marvell also a standout on the back of its upbeat data center outlook, also announced a deal for Celestial AI. And then the retail front is more of a mixed picture here. We have Dollar Tree and American Eagle as the winners. Laggards, Macy's under pressure despite a surprise profit. Its sales outlook underwhelmed. And then Bitcoin also catching a bid, clawing back from its November setup. But I also want to take a look at the commodity trade, in particular natural gas that is ripping higher. Futures are at a 3-year high. We have natural gas flirting at $5. Prices are now up over 20% over the past month as cold weather demand ramps up and data centers soak up a huge amount of that power. So something that we're going to be keeping an eye on. But keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the session.
Well, as Allie just mentioned, U.S. natural gas futures hit $5 for the first time in almost 3 years as cold forecasts for early and mid-December raised expectations for winter heating demand. Of course, there could be other factors affecting prices. Joining us for more Yahoo Finance's Jake Conley, making his debut here with us. So, Jake, you watch this stuff closely. What's going on with these natural gas prices?
Yeah, it's a few things. I mean, obviously the news today, natural gas broke through $5 for the first time since December 2022, breaking kind of a 3-year streak that's seen some pretty choppy movement between the $3 and $4 range. Finally, we're getting back above that. And it's a few things. I mean, the first overall, it's about to be winter, right? As it gets colder, more people turn on their heat. Much of that is natural gas, so that's going to draw. The other thing here is the U.S. has been bumping its LNG, liquefied natural gas exports up, right? So that's going to tighten the amount of gas available for the market for storage. The real wild card here, though, is going to be the power demand from this data center boom, right? Building a new nuclear plant takes 10 years. Getting connected to the U.S. power grid for steady power takes 5, 6, 7 years sometimes. So what is the answer for a big tech company who wants power right now? A lot of the times it's going to be plugging into an existing natural gas asset or building something new in 2 to 3 years. What that's doing, though, is choking a lot of the supply, taking a lot of it off the market, and so prices are going to go up as a result.
And it's been so interesting, the change that we've seen in U.S. power generation over the past, call it 2 decades, which has become so much more leveraged to natural gas as we've weaned ourselves off of coal and some of the other fossil fuels. So, you know, now natural gas feels like the most important power source for us from a plugging into the grid perspective.
Yeah, I think that's right. Again, you know, nuclear is great and it's great in theory, but it takes a long time to develop a nuclear asset. Coal is kind of become a thing of the past, though if natural gas prices keep going up and maybe some of that coal gets restarted. But renewables are great, but they're really not there yet at scale and at power to deliver the kind of energy that the US needs, especially as energy demand is spiking like crazy with the AI boom. Natural gas is cheap enough, it's abundant enough, the infrastructure exists, so it's kind of become the darling of the day for US energy.
Now, what are we going to see in terms of this now little bump up in natural gas prices to this level we haven't seen in 3 years? How does that then transmit to electricity prices, where there's already a lot of concern about rising electricity prices?
I mean, it's directly correlated, right? Utilities need to purchase the natural gas to supply electricity. If that raw commodity price is higher, they're going to pass that cost on to consumers. Electricity bills are going to go up. Obviously, already a hot button issue because you look at Loudoun, Virginia, right? Ohio, some of these really data center heavy spots. Electricity bills are already spiking. People are already seeing it in their, in ratepayers' bills. If natural gas goes up, that's just going to keep going. And obviously, you've got into this cycle, right, where as more power demand happens, we need more natural gas pull. As there's less supply in the market, prices are just going to keep going up.
Not great news heading into a season where many of us are going to be turning on our furnaces or heat pumps or whatever we're using for our houses. Jake, thanks so much.
Thanks,
Appreciate
Julie.
it. We got much more markets action coming up. Stay tuned. You're watching Market Catalysts.
Health insurer Curative announcing a new fundraising round, bringing its valuation to unicorn status, meaning above $1 billion. The company is looking to disrupt the insurance industry with a focus on preventative care. Joining me now is Fred Turner, co-founder and CEO of Curative. Fred, it is good to see you. So let's get right to this headline. You raised $150 million, Fred. I'm impressed by the A-list investors here. You got Druckenmiller, I see Novogratz. These are big guys. Walk us through the news and how you intend to put this money to work, Fred.
Yeah, thanks for having me on, Josh. So we're excited to announce today our Series B round in Curative, 150 million at a 1.3 billion valuation to really keep scaling our model of employer-sponsored health insurance that actually focuses on prevention. So we use a combination of engagement and preventative health to really get our members to engage as early as possible, go and take care of themselves. And we see that then translate into results, about a 30% reduction in inpatient hospital admissions within 6 months of an employer group moving to the Curative model. So we're planning to use this funding to continue scaling up. We started the health insurance business about 3 years ago now. And currently we're operating in Texas, Florida, and Georgia. And we're planning to use this funding to scale up nationally. So we'll be starting first in Maryland and DC, but looking to launch in Indiana, Ohio, and hopefully New York. And then over the next couple of years, roll this out nationally.
You talk, Fred, here about how AI-driven member experience is a big investment area. Just walk me through that a bit more, Fred. I mean, where do you see the significant automation coming?
Yeah, I think it's a really exciting time to be building in the insurance space. Yeah, it's usually maybe not considered the most exciting market, but it's an incredibly document and interaction heavy industry, right? We, even as a small insurance company, receive 10,000 pages worth of faxes every single day. And so historically, you would have these vast, office buildings of people manually working through this, and that leads to very slow responsiveness for members. It takes a long time to get anything done dealing with an insurance company. And what we're finding now is that if you build from the ground up in the age of AI, you can design those processes to be AI first, so you're not having people manually reviewing thousands of pages. We can get faster decisions, and we can really make the entire experience much more user-friendly. And really focus on the product that we're actually delivering to the consumer at the end of the day.
Fred, it looks like you have this zero out-of-pocket plan. Walk me through that, Fred. Just explain that model to me, and what are the unit economics at play, Fred, that sort of make that sustainable?
Yeah, so there's, I think, long been this idea that we have to put in place these barriers to people seeking care, otherwise people will dramatically overutilize. But the data in the literature has really shown that the opposite is almost true. That when you put in place these barriers, deductibles, copays that are supposed to make people good consumers, that they'll go and price shop, only get the necessary care, it's just not what really happens in reality. When you put in place those barriers for people, what happens is they just stop seeking all care. They don't go do the preventative visit. They don't go do the screenings. They don't go get their colonoscopy or their mammogram. They put all that stuff off because they want to avoid the out-of-pocket cost, or even the perceived out-of-pocket cost if it would maybe have been free as a preventative service. And they delay and delay and delay until what could have been a simple, straightforward intervention is now becoming a more expensive procedure, an expensive specialty medication, or even an inpatient hospital stay. And so by creating that financial barrier, what you're really doing is just kicking the can down the road and saying, well, we won't spend any money now on prevention, but we're going to spend a lot more money next year or the year after actually dealing with the consequences of that. And so what we do with Curative is we remove those financial barriers. So on day one, our members have no out-of-pocket costs, no copays, no deductibles, no coinsurance. They can actually go and get care, and they know what it's going to cost them. And everybody gets that for the first 120 days on the plan. And then during that 120 days, they have to come to us and do a preventative health visit, which we call the baseline visit. And as long as they show up and do that preventive health visit just once a year, they get to keep the no out-of-pocket for the rest of the year. But if they don't show up, on the 121st day, they go back to a $5,000 deductible, 20% coinsurance, and a bunch of copays. And so we're able to get 98% of members to actually engage, show up, and do that preventative visit. And that's really what allows us to drive the effective intervention with those members.
You know here too, Fred, you have reached profitability. I'm curious how durable, Fred, you think that profitability is as you're now, building, investing, and scaling?
Yeah, we expect to continue being profitable and to grow the profitability of the business going forward. I think obviously in insurance, it's very much a scale game. You have to reach a certain scale before it's possible to be profitable. So we've been growing rapidly and investing, over the last few years in getting to that profitability. We're now about 165,000 members on the plan, but we grew 100% this year. So we're hoping to keep that growth rate going, but do it in a profitable and sustainable way.
What do you think, Fred? Last question. I mean, ultimately, what's the exit strategy here? Is it IPO, Fred? Strategic acquirer? What do you think?
Yeah, we're looking to build a big insurance business. I think there's a gap in the market for a plan that is really focused on prevention and building something that the end consumer actually wants to have as a product. I think health insurance is this strange part of the market where we spend so much per year on the product and then are generally dissatisfied with it. I think most other areas of the economy, when you spend $10,000 a year, you're generally pretty happy or at least understand the value you're getting from that investment. And I think we're kind of reached this breaking point with health insurance where people are not happy with what they're getting. And I think there's a gap in the market for a new large health plan that provides that preventative care and that consumer experience that people are looking for. So We're not looking to sell out anytime soon.
Over the last 7 trading days, small caps have quietly run ahead of the pack, climbing above their much larger cousins in the S&P 500 and the Russell 1000 indexes. Even with mega cap tech and the chip trade coming back, small caps are starting to steal the spotlight. And this recent surge might not just be a one-off pop, as this tends to be what happens this time of year. Small caps are now positioned to ride out what historically tends to be their best 3 months of the year over large caps. And that's what we're breaking down on today's Stocks in Translation. Now, here's some basics you need to know. First, we're going to be talking about 2 different indexes, the Russell 2000 and the Russell 1000. The Russell 2000 contains about 2,000 stocks with a market capitalization or market cap of under about $4.5 billion. Those are the small caps. The Russell 1000 is like the S&P 500. It has the large and even the mega caps, only stocks over about $10 billion in market cap. And in a minute, we're going to take a look at the ratio of these 2 indexes, the Russell 2000 divided by the Russell 1000. But next, small caps often lag their larger cap cousins. But from about mid-December through early March, they've got a strong track record of doing even better. Now, this doesn't mean that history says they should be green this whole time. If they do go down, they just tend to go down less than large caps. Now, let's take a look at a chart of that ratio of the Russell 2000 divided by the 1000 over time. This is the work, by the way, of Jeff Hirsch over at the Stock Traders Almanac, and this chart starts in July and goes for 1 year. And there are 2 lines. The white line is the average of the ratio going back to 1979. That is our map. And the green line is what's happened so far since the start in July. When small caps are doing better than large, the line moves up. And when they do worse, the lines move down. Those numbers at the extreme left and right of the chart just refer to the ratio of the 2 indexes. They're really not that important. Now, notice how that green line is approaching the shaded area, which is the sweet spot for small caps. From mid-December through early March, it looks like the outperformance might have already gotten started this year, but we don't want to get too far ahead of ourselves. Now, let's call out the differences here because size matters. Small caps mostly tied to the U.S. economy, at least more so than large caps, and more sensitive to interest rates and credit conditions. And that's why they can swing harder in both directions. Large caps, on the other hand, tend to have a global revenue stream and stronger balance sheets, so they tend to hold up better during downturns and slowdowns. Small caps also tend to have less concentration risk. They're not dominated by 5 or 10 stocks the way the S&P 500 or the Russell 1000 are. But picking small cap stocks can be a tricky business, as analyst coverage tends to be lower. You really need to research what you're buying. So let's talk technicals now. In this 5-year chart of the iShares Russell 2000 ETF IWM, you can see that this is now the 3rd time that price has traded above that key 240 level, which translates to the 2400 level on the Russell 2000 index. Each breakout attempt was quickly reversed after it failed, and when we hit it in October, there was a steep sell-off again. Small caps have truly frustrated investors over the last few years, so a big test is going to be if IWM can hold that 240 level. Maybe bullish seasonality means a difference this time, but that is an open question. So here's what to watch next. First, can the Russell 2000 finally hold that 2400 level and IWM its 240 level and stay above them? These are the lines in the sand. Next, do small caps continue to outperform even with normal pullbacks? Seasonality, it doesn't mean that every day needs to go up. It just means that the odds tilt in their favor. Then, are you trading broad exposure with an index ETF like IWM, or are you trading individual names? Remember that stock picking is even harder in the small cap space. So look for strong balance sheets, and yes, that means some fundamental analysis here. So as small caps try to break out of a multi-year ceiling, they've got the seasonal tailwinds and things are already swinging in their favor. A sustained rally from here would finally break the cycle that's frustrated the bulls for years, but more frustration wouldn't be too much of a surprise either. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts up next.
American Eagle shares popping after it beat Wall Street's estimates for the 3rd quarter and raised its forecast. American Eagle expecting 4th quarter sales to grow between 8 and 9%, well above the around 2% that was expected. Even so, my next guest reiterated a neutral rating on the stock. Let's talk about why and what's next for the company. Janine Stichter is here with us, BTIG Consumer, Retail, and Lifestyle Brands Analyst and Managing Director. Thank you so much for being here. So just sort of like big picture, what did you think of the quarter for American Eagle?
I think the acceleration that they're seeing in the top line is really a positive surprise. From what we've heard across the industry, Black Friday and the start to holiday has been good, but they really saw a market acceleration. They guided for Q comps up high single digits. We've been looking for kind of a low single digit, and it's just really trending better than expected. So I think this was all positive momentum. The question around this just becomes the durability and the sustainability of this momentum that they're seeing right now.
And obviously, American Eagle has also tried to sort of tap into the zeitgeist in various ways with celebrity spokespeople, right? We got Travis Kelce, we got Sydney Sweeney, we got Martha Stewart. How much do you think that is juicing sales for the brand?
Yeah, I think that's exactly what investors in the market are trying to parse out right now. They had a really tough start to the year, and then all of a sudden, as you got towards the end of Q2 into early Q3, things started to get better. And a lot of that coincided with the Sydney Sweeney campaign. Travis Kelce came right after that, and now we have Martha Stewart helping them to kick off the holidays. So I think it's really hard to separate how much is just buzz around the brand from some really high-profile campaigns, very different from what they've done in the past, versus how much is better product and better execution. And it seems like they've attracted a lot of new customers, particularly online, from these campaigns. But the question we have go forward is, do these consumers actually stay with the brand and continue to shop with American Eagle?
And I guess that will depend more on product, assortment, quality, all of that kind of thing.
I think it's exactly that. From here now, they have the consumer's attention. That was the goal of these marketing campaigns. And now the onus is really on them to continue to execute around product.
Who are these new customers that they're drawing in, Janine?
I think it's broad. The interesting thing with Sydney Sweeney is that, while she is a female celebrity, I think she actually does have a bit of a male audience that follows her. And they did see the men's business accelerate in Q3. Part of that was probably Travis Kelce as well. With the Martha Stewart campaign, which is relatively new, I think the interesting thing there is you don't think of her as necessarily someone who resonates with the younger consumer. But it sounds like she actually is really helping to attract Gen Z, because she does have a certain resonance with Gen Z that she's built over the last few years as she's kind of reemerged as a Gen Z celebrity.
I would not have picked that on my 2000 bingo card or whatever. So it sounds like you're a little bit cautious here. The shares are up already 45% this year, even given, I should say, including the action that we're seeing today. So it sounds like you want those questions answered before you would go to a buy on the stock.
Yeah, I think it's exactly that. I think that they've definitely put the product issues of the first half of the year in the rearview mirror. There's a lot of good things going on from a marketing and product standpoint. But when we sit here with the stock having had a big bump after Q2 and now another nice run after Q3, the multiples are at the upper end of historical averages. They're above a lot of their peers. I feel like the estimates, having come up a lot today, are reasonable, but there might not be a lot of upside there. So I think we kind of need to see how sustainable this is to get excited at these valuation levels.
What's also interesting to me is you got these celebrity campaigns that are to do with American Eagle itself and denim, et cetera. But the Aerie brand is kind of killing it here. Comps there up 11%. And this is, if I'm not mistaken, this has been a pretty consistent area for them, right?
It has been for the most part. The one area where they stumbled was similar to the American Eagle brand. In the start of the year, they had some product execution misses, and they actually comped negative for the first time in recent history at that brand. But it seems like those issues are fixed. And then I think the marketing campaigns that they had, mostly for American Eagle, did have some level of halo effect to the Aerie brand as well. Because if you look at where the upside was, American Eagle did improve, but a lot of it actually was from Aerie, which it sounds like quarter to date is comping up probably in the 20% range.
When you look at direct competitors to American Eagle, I mostly think of Abercrombie, although I'm sure there's a lot of online brands that compete directly too. Do you think those are more attractive right now?
We think Abercrombie, we have a buy rating on Abercrombie, and we think it's more attractive just because of where valuation sits. You have American Eagle trading at, call it 13, 14 times, whereas Abercrombie's more like 8 or 9 times. And I think there's a lot of questions around the potential for improvement at the Abercrombie brand after they've had kind of a rough start to the year. And then with Hollister, we think that the growth there is underappreciated. So I think there's more opportunity at Abercrombie from a stock perspective. I do think both of these companies are executing well right now.
Janine, thanks so much for your perspective. I appreciate it.
Of course, thanks for having me.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.